Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
In a way, this is not unexpected. I think everyone has been anticipating that as you see this continuation of US-China tensions, that unfortunately some of these chip makers' technology almost falls right into the spotlight. Now, we continue to like those mega cap technology names, a lot of the software chip makers, but probably would not be adding exposure at this point and really looking across a broad portfolio to really think about diversification.
The Russell 2000 index, kind of the benchmark small cap index, it's had its biggest move in terms of standard deviations that we've seen in more than 30 years over the last week. Now, it may end next week, who knows? But I got to tell you, I've been doing this a long time, and it's a very convincing reversal.
I couldn't be more proud of what the R&D teams have really established with respect to data readouts to fortify not just the balance of this year, but really the balance of this decade with respect to new products, new indications coming online that will not only help patients, but certainly lead to much better business results.
We've got 1 hour to go until the market close. So let's take a look at the major averages here. And we continue to see this interesting disconnect. One could call it a rotation, but it's not going by exactly the same playbook that we've seen in recent days. Today, the Dow is higher by 221 points, about 0.5%. Then we've got the S&P 500, which is sharply lower, 1.3%. The Nasdaq, even more sharply lower, 2.7%. So where's the money going? It's going into the Dow. It is not going into small caps, at least not today. After the run that we've seen in small caps, it's down 0.8% today. If you look at the 5-day chart, we've had a big run up in those small caps, but that is ending, or at least pausing today, Josh. But I know we want to talk a lot about what's going on in the semis.
Yeah, I mean, you pointed out the Nasdaq is sliding today a bit, and really the focus has been on the chips. And if you looked at the SMH, which is the ETF that tracks the chip, you would see that kind of sharp move lower. Although also, I mean, if you pull that back the chart, Julie, that sector has been one of those names that investors are just piled into because they're excited about AI, because signs of end markets improving. So we're down today, but what a run. I mean, you're still up about 45% this year.
Absolutely. Yeah. You know, down around 8% or so from the highs where it was on July 10th. But just to catch people up in case they're just tuning into the markets today, there are really two things that seem to be putting pressure on this group in particular today. One, there are reports that the Biden administration is considering new, tougher rules, particularly on chip equipment makers, if they deem that those chip equipment makers are selling into or sharing technology with China. So that's thing one. Thing two, former President Trump, in a just published interview, talked about pulling back on some support for Taiwan, or at least having Taiwan pay for its own kind of defense.
Suggesting they'd have to pay if they want U.S. protection.
Exactly. Right. So you're seeing Taiwan Semiconductor in particular down by 8% today. To your point, the stock is still up 64% this year. Yeah. So when you pull it back, it does look small in those terms. But ASML, which came out today, reported its bookings had increased. Those shares up 23% year to date, but they're down today
look at that move.
12% because of these headlines. And then just a quick look at NVIDIA, because of course this is the biggie of them all, down 6% today. Now, does the story fundamentally change because of what's happening today? Unlikely in the short term. You know, that stock's up almost 140% this year. So does that now change on a dime? We're going to talk much more about this throughout the show, if these perceptions are changing with the rotation happening and with these new headlines.
Yep. All right, let's get more perspective, Julie. As we're seeing this sell-off in the tech sector, we want to welcome in Ed Yardeni, president of Yardeni Research. Dr. Ed, always great to have you on the show. So you heard the two of us talking there. Interesting moves today, Ed. You know, NASDAQ is slipping. Lots of attention from investors on the chips, of course, moving on those headlines. Let's start there, Ed. What do you make of the market action you're seeing in today's trade?
Well, I think that it's a lot of confusion, quite honestly, on a day-to-day basis. There's a lot of confusion about whether this is it. This is the great rotation into SMID caps, or whether this is just a short covering rally by a bunch of hedge funds that were short the mid caps and long the mega caps. There's a lot of confusion about what the economy is doing, and the economy looked pretty good on today's economic indicators. The housing market looks like it's bottoming, and industrial production was relatively strong, which kind of makes you want to scratch your head and say, well, so why is the Fed lowering interest rates exactly? So it's a lot of cross currents here, but I think the Fed is pretty much locked into lowering the Fed funds rate in September by 25 basis points. They've made it pretty clear that's what they want to do. The inflation rate is definitely going to go in the right direction in that case. And I think we're in what I would describe as a broadening melt up in the market. It had been very focused on the mega cap, and now I think it's spreading to the rest of the market. And I particularly like the S&P 493, all the stocks except the mega cap 7.
And so, to your point, how do we know if this is going to last, or do we just wait? Or are there things that you can kind of look at that'll help you signal that?
Well, first and foremost is what is the economy doing? If it is heading into a recession, then we don't want to be in any highly exposed, economically sensitive areas of the economy with high valuation multiples. But I don't think the economy is heading into recession. There's still people, I call them the die-hard hardlanders. They just convinced that we're going to get a hard landing here. I think they've been proven wrong for the past couple of years, and they're wrong again. So I don't think we have to worry about a bear market. And so what we have to worry about is what sectors do we want to be in. And I think for the long haul, you want to stay with technology for sure. I think communication services also are an area where you want to be involved. I think some of it is AI related. Some of it is simply that technology companies can solve a very important problem we have, which is a shortage of skilled workers. I think you want to be in the industrials, particularly as a result of onshoring. And I like financials as the yield curve disinverts, if you will.
And Ed, quickly, you did mention small caps. I do want to get your take just to drill down a bit more into that, because listen, it's been such a subject of conversation for investors.
Yeah.
The move there, Ed, just quick and aggressive. You see them pulling back today a bit, although, you look at the Russell in 2000, I mean, it's down less than the SPX, but your thoughts on the small caps, Ed, when you're talking to clients, what do you tell them?
Well, the thing that's been discouraging about the small caps is how poorly they've been performing all along here until the past week. And so that kind of raises the legitimacy of this rally. It may very well be related to just simply that the market expects the Fed will cut rates, and smaller cap, mid cap companies will benefit more from lower rates. But when you put a microscope to it, you'll see that the big moves have been in biotech and also in banking, regional banks, small regional banks. And a lot of that could just be simply short covering. I don't know that their fundamentals have radically changed. So I'd be a little wary of of chasing the mid caps, the Russell 2000, but I think the market is broadening within the S&P 500.
Ed, I want to ask about fixed income and what we're seeing in the rates market right now, too, because, of course, we've seen the 10-year yields come down with this expectation the Fed's getting closer to cutting here. What are you watching for in that market? And do you think that right now the market's sort of adequately reflecting the outlook for the Fed on that side of the equation?
Well, I think from what I understand, that the market indicators are showing is there's a 100% probability that the Fed will cut the Fed funds rate by 25 basis points in September. So I gotta believe that that's in the bond market, that's in the stock market, that's anticipated. And I think, when you look further out over the next 12 months, the federal funds futures markets are basically anticipating 5 rate cuts over the next 12 months. Now, the futures markets have been wrong before, they could be wrong again. I do think there's going to be a September cut, but I'm not quite convinced that there's going to be a lot more cuts after that. And I think the bond market's also somewhat skeptical. And the bond market, meanwhile, has to deal with supply. There's a lot of bonds and notes that the Treasury is going to be issuing. So I'm looking at a 4 to 5% wide trading range for the bond market. I don't think we're going to drop under 4%, but there are people who are convinced that's about to happen.
And when you say you'd be looking for a cut in September, but not many more after that, how come, Ed?
Well, look, past couple of years, a lot of people were looking for a recession. I wasn't there. I didn't anticipate that there would be a recession, and it's the same story now. The economy looks like it's pretty resilient. Looks like, the Atlanta Fed's GDP now was just revised to show an increase of 2.7%. It's been, that's up from 1.5% a few weeks ago. So the economy is looking pretty good, and meanwhile, inflation's going in the right direction. So what's the rush to lower interest rates? I thought the Fed's game plan until recently was to wait until inflation actually does get down to 2% and stays there for a few months. And now they seem to be changing the rules and saying, well, we're almost there. That's getting close enough. So if we continue to move closer to it, we'll go down to 2%. I can't ignore what they're saying. They're in charge, not me. I'm concerned that if they lower rates when it's not really necessary, we'll get a melt up in the market. And the problem with melt ups is they tend to be followed by meltdowns.
Although we've seen a pretty good melt up thus far this year, I don't know. Is this the meltdown that we're now seeing?
No, I don't think so.
All right.
No, I think there could be more to the melt up, quite honestly.
All right. We will check in with you soon again and talk about it. Thanks so much, Ed. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, U.S.-China relations are in the spotlight this election season. We'll discuss the policies at play and the implications for markets. Plus, United Airlines reports second quarter results after the close. The airline stock, one of the best performers in the sector so far this year. We'll watch if the company can continue to soar higher. That's at 4 p.m. But first, we'll take a closer look at some of today's top trending tickers here on Yahoo Finance. Stay tuned, more to come on Market Domination. U.S.-China relations front and center. Chipmakers are under pressure as the Biden administration reportedly considers tighter trade rules on China. The trade conflict with China, however, just being one point of tension between the nations. Meanwhile, former President Donald Trump speaking out about Taiwan, sidestepping a question of whether the U.S. would come to the island's defense. Joining us now, former U.S. Ambassador to Singapore and CraneShares Managing Director, David Edelman. David, thank you so much for being here. So we are looking at these headlines today and trying to parse out what is the state of the U.S. relationship with China, particularly when it comes to trade. I guess we'll take that part of it first, where we hear the Biden administration, according to these reports, is proposing maybe having even more stringent requirements on selling of chip technology. What do you make of that? Do you think there's going to be any response from China? And what does it achieve in the end?
Well, first, thanks for having me on. I think the general state of U.S.-China relations is unchanged. We are in a strategic competition with China. These are two very large economic powers competing within a single system, a global economy. I expect there to be a lot of very sharp rhetoric in the next 3.5 or 4 months in the run-up to the U.S. general election in November of this year. There is bipartisan consensus in the U.S. Congress and really throughout Washington that is forming or has formed around a more hawkish, more muscular policy towards China. But nonetheless, there's also a clear recognition that the U.S. economy and Chinese economy are interdependent, so to speak. Now, with regard to the specific headlines you referred to, I do expect the Biden administration to continue to look towards export controls as a way to, in the interest of national security, protect against certain very specific chip manufacturing equipment being exported to China. I think that will have perhaps the unintended consequence of accelerating mainland China's chip manufacturing and foundry ecosystem. With regard to the Trump comments related to Taiwan, look, America's policy towards the defense of Taiwan since 1979 has been based on this idea of strategic ambiguity, if you will, leaving open the question of the extent to which the United States would actually respond with its own troops in defense of Taiwan should there be military attack across the Taiwan Strait. So I think the Trump comments are consistent with American policy since 1979. The news, I suppose, is around this idea that former President Trump has argued that Taiwan should be spending more on its own defense. My interpretation of that is it's similar to the Trump posture towards all American allies, whether they be in Europe or Northeast Asia or elsewhere, that other countries should be increasing their defense spending, which inures to the benefit of U.S. defense industries, I would add.
David, I want to go back to something you said because the U.S. government has been very focused on trying to stymie China's ambitions to become this real global tech powerhouse. It sounds like you were saying, David, that you don't think we're going to have much success in that effort long term.
I don't. I think the Chinese economy is very powerful, and I think it's in America's interest to try to run faster rather than trip your opponent in this race towards, a technological advantage. I worry that export controls that go too far could ultimately inhibit or impede the development of chip foundries and chip manufacturing outside of China and could actually accelerate China's development of its ecosystem. Look, China has made it very clear that they are interested in a domestic chip manufacturing ecosystem, and they will and do have the resources to invest in the development of that system. It may never really compete with that which exists in Taiwan, which has the special sauce, so to speak. But nonetheless, I think it can meet China's demand for chips. And this is especially of concern if you are convinced that this sort of high-end chip manufacturing capacity raises real national security concerns for the United States. I'm less convinced.
So if you are indeed less convinced and you don't think that's a good strategy, what do you think, what is the alternative strategy in that case then? What do you think, whether it's this administration or whoever the next administration ends up being, what do you think the strategy should be?
The alternative really is to double down on the U.S. and Taiwan's chip manufacturing ecosystem and create a dependence, if you will, so that China is dependent on foreign manufacturing and foreign foundries for chips. That was the case until relatively recently, and I just worry that export controls, if they're too strict, can have unintended consequences. I think the same is true for any trade tariffs. I think it could have the unintended consequence of, in some ways, strengthening Chinese manufacturing capability and promoting Chinese products to markets other than the United States. If you haven't caught on yet, I'm a big believer in globalization, and I'm a big believer that the integration of the Chinese and American economies are irreversible, and that we really both operate in a single global economy. That's not to say there should be no export controls, but when I served in the government and Bob Gates was our defense secretary, he was a strong advocate for the so-called higher fences around, a smaller yard. And I certainly believe that export controls are appropriate. But I think if we're overly inclusive in those export controls for political reasons, they could have the unintended consequences I've described.
David, really interesting stuff to consider as we continue to follow this developing story. Thank you.
Thank you.
Leading the Nasdaq slide today, semiconductor stocks. The chip sell-off coming amid reports the Biden administration is considering even stiffer regulations on exports of high-grade American semiconductor technology to China. And joining us now is Matt Bryson, Wedbush Securities Senior Vice President of Equity Research. Matt, it's great to see you. I actually wanted to start, Matt, on these comments that got a lot of attention that former President Trump made in this interview with Bloomberg Businessweek. Matt, I know you saw it, but he said Taiwan took our chip business from us. I mean, how stupid are we? They took all of our chip business. They're immensely wealthy. The reaction, Matt, and some of the names you cover, I know you covered Taiwan Semi. It's down, Matt, almost 8% here. What's interesting for investors to think about is, we are building out our domestic chip manufacturing in this country. We're putting a lot of money and time and effort into it. But it's such an enormous project, Matt. I mean, there are analysts who say if you're really going to do that, it's not just money. You have to think about your education policies, your immigration policies. It's enormous. For now, we are very much, and listen, you know the company, you know the space. It seems to we're still very much dependent on some of these names getting hit today, like Taiwan Semi.
Yeah, no, there's no way you can move away from Taiwan Semi anytime in the near future. When you think about iPhones, right, the core processor of every iPhone comes out of Taiwan Semi. Every AMD chip, so a lot of our server chips, a lot of our PC chips, they all come out of Taiwan Semi. NVIDIA, so all their AI chips are fabbed at Taiwan Semi. You can go down the list. Qualcomm, so again, every smartphone modem, because MediaTek as well is fabbed at Taiwan Semi. And so, no, we can't live without Taiwan Semiconductor. And when you think about how much money Taiwan Semi has been spending on equipment, 30, 40 billion a year in terms of CapEx, you can't replace it even if you can duplicate their technology. And so, no, Taiwan Semi is not going anywhere anytime soon.
Matt, so given that, do you think that the sell-off that we're seeing in this group today is justified? Do you think that people should be taking these threats seriously? Or because of what you're saying, like Taiwan Semi is not going anywhere, we need them, or the US-based chip makers need them, that there isn't a real threat that, that any US administration would let there be threats to the island?
I mean, I certainly would say that there are more likely losers, if you will, from shifts in Taiwan in U.S. policy towards China. So not necessarily commenting on ex-President Trump's remarks, but when you look at what the U.S. is doing in terms of restricting capital equipment sales into China, if they are successful. Certainly that would weigh on ASML, that would weigh on some of the other capital equipment names, Tokyo Electron, and that's something to think about. Chinese policy, if those restrictions go into place, China's been far less aggressive in blocking or affecting U.S. companies. So maybe they'll take that line again, and so it's not so much of an implication. But certainly, companies that export to China, if China takes a harder stance and starts banning imports, that's something to think about. But in terms of again, things shifting immensely for someone like NVIDIA, where China is a relatively small portion of their revenue because there's already such significant restrictions in place. Thinking about moving away from Taiwan Semi anytime in the next 2 to 3 years, I just don't think there's any real implications, right? There's no alternative to Taiwan Semi. There's no strong alternative to NVIDIA at this point.
And Matt, another name in your coverage universe I want to get your thoughts on, Intel. And it's interesting, Matt, because it's kind of bucking the trend here today. It's actually up about 1%. I'm not sure what to make of that, Matt. Maybe some investors are thinking, well, CEO Pat Gelsinger, he's actually building those chip plants here in the U.S., so he's on the right side of where a lot of American politicians are at, just ideologically. But that name, you still have a neutral on, Matt?
Yeah, I have a neutral. The neutral comes down to I think at the end of the day, whether Intel is successful or not depends on its ability to get its chip manufacturing back to where it used to be. Right, 5 years ago, Intel was the leading company in terms of chip technology, in terms of manufacturing. Now they're not, and I'm still a little bit unclear on how that path progresses. Hence the neutral. But with Intel today, I think certainly it's Intel being viewed as an alternative to Taiwan manufacturing. The other stock in my coverage that's up today is Global Foundries. I would say for Intel, it's a bit of a mixed bag. Certainly, if there's a push towards supporting U.S. manufacturing, that benefits Intel, and then it gives them more resources to right the ship on the manufacturing side to get to Pat Gelsinger's vision, if you will. But at the same time, they also ship a lot of server and PC compute to China. So if you go down the path of further China restrictions, could they be affected? Maybe. Global Foundries, it's an easier story, right? They are an alternative to Taiwan Semi, to UMC for more mature processes. And so if you see a risk-off shift in terms of sourcing semiconductors, sourcing foundry capability, Global Foundries is an alternative to that Taiwan production.
Well, I guess that helps explain why the shares are higher today and bucking that downtrend. Matt, thanks so much. Really helpful stuff.
Thank you.
Let's check out some other trending tickers here on Yahoo Finance today. First up, let's talk about GitLab. It's a software maker that's reportedly exploring a sale after receiving acquisition interest. Alphabet, by the way, is one of GitLab's investors. It owns about a 22.2% voting stake through its VC arm. One of the companies that's been talked about as a potential suitor for GitLab is Datadog, and those shares have been trading sharply lower today. You know, we've seen a little bit of a tick up here in tech M&A, so this would be another one, I guess, to add to the list.
Yeah, interesting. This is like a little deal-making news, sort of, maybe. And, you know, we had those reports, use Alphabet in talks by Wiz for about $23 billion.
Right.
On this one, you know, GitLab shares, no surprise you saw a pop jumping on those headlines. They're still, I mean, just looking at the chart, still down hard this year. And then you always try to think, what would trustbusters in Washington think about that? I did see some analysts cited as saying, you know, they were, if it was going to be a tie-up with GitLab and Datadog, they were positive. They thought there was less regulatory risk there to that kind of transaction. So we'll see how it plays out.
Well, I believe Microsoft had bought GitHub which is a competitor to GitLab. So part of, I guess, the motivation is also to be a more formidable competitor to that Microsoft entity. Just to give a little perspective here, you mentioned the stock is down 14% this year, or you mentioned it's down this year. It went public in October 2021. It was the class of 2021, part of that class. It went public at 77 bucks, so it is trading below that level, like so many of the companies that came public that year.
All right, our next trending ticker, U.S. Bancorp, the parent company of U.S. Bank National Association, reporting earnings Wednesday morning, topping analyst estimates on both EPS and revenue. Nice pop of about 4% right there. So adjusted earnings per share for Q2 beats consensus. Analysts at Bloomberg, Julie's saying yes, operating trends, they said, look solid, improved balance sheet growth. They called out guidance points to a stable results in Q3 as well.
Yeah, and that's something that the company said too, that third quarter net interest income specifically would be relatively stable versus the second quarter. So that's something that it seems like investors want to hear right now, that sort of predictability from net interest income. Those USB shares, by the way, are up between 4 and 5% this year, so they've actually lagged the financials broadly. So playing a little bit of catch up here today, you can see that chart looks relatively volatile this year.
All right, final ticker.
Oh, J.B. Hunt.
I almost jumped on you. I was so excited to talk about J.B. Hunt.
Hey, who doesn't love to talk about trucking? That stock, though, is lower after missing on earnings. The logistics services and freight shipping company saying it will continue to play the long game with its approach, despite overall freight demand remaining underwater. And it seems like the main problem here is pricing and margins for J.B. Hunt, that's where the weakness came from yet. That maybe even if volume starts to get better, the pricing trends, according to analysts, are not necessarily getting better.
Yeah, I thought some of the commentary on the call was pretty interesting. They talked about puts and takes on the top line. Said it was a combination of either lower volumes and our yield, but most notably lower rates were the main drivers of the lower revenue. They also, I saw some of the color they gave about their customers, worth mentioning too, Julie. It said our customers have worked through most of their excess inventory. They now feel appropriately right-sized with current sales activity levels, and then went on to say we cannot predict when the market will inflect. Our customers know we stand ready to meet their growing transportation needs across our entire scroll of services, to which the strategist Peter Bukvar added, the entire manufacturing world is waiting for that inventory restock inflection.
Yeah, I mean, there have been a lot of inflections over the past couple of years, so they've been, there's a lot of whipsawing in the industry.
All right, the iconic Cadillac Escalade getting an upgrade for the 2025 model year. We're going to have the details on that next on Market Domination.
General Motors is updating its flagship Cadillac Escalade. For more, we're bringing in senior autos reporter Pras Subramanian to talk about that. So, the Escalade, what are they doing to it?
Well, you know, it's a big deal because this is a big franchise for Cadillac, and this is I believe this is their mid-cycle refresh. So, 3-4 years into a new model, they'll refresh it with new exterior features, new interior enhancements to kind of give it another look for people that want to maybe re-up a lease or just go into it as a brand new vehicle. So the Escalade, right? So the Cadillac sold around 41,000 Escalades last year. It's about about a third of their overall sales, but this is like high margin product, very, very good business for Cadillac. They said they sold over 1 million Escalades throughout the history of the brand globally, so there's a lot out there. But some of the enhancements, you see the grille here, very sleek-looking lights, and of course that monster grille. Inside, by the way, there's a 55-inch widescreen display. It goes across almost the entire dash, including a little passenger area there.
Well, my 5-year-old would actually take a long drive at that point.
This is what we want.
That's in the front seat, though. That's on the dash.
This is the full dash.
Yeah, that doesn't work.
Massive screen there, and then also a little one for the passenger. So we're all used to the screens and everything like that. So it kind of gives it a more futuristic look. Interestingly, it has CarPlay, which is a big deal because most GM cars were kind of going away from that. I'm not sure if this is only for EVs or not. Lastly, GM also, this is the Cadillac V-Series high-performance version of this Escalade. They're going to increase production of that vehicle to meet demand. This is a car that costs $150,000.
And this isn't electric, to be clear.
Not yet. That's the Escalade IQ. That's coming out, I think, later this year.
Got it.
And so what America needs to know, Pras, have you taken a test drive?
Well, that Escalade V-Series, we did get that for a weekend once.
What'd you think? Give me
680 horsepower in a full-size SUV and has a custom exhaust that sounds crazy. It'll wake up the whole neighborhood when you go into it. But it's kind of like the excess of America in sort of defined form, right? This is a big, brash SUV, has almost like a race car engine in it. Why? Because Americans can do it, because GM can do it, people want it.
Because you can. Yeah.
That's really what it's about. And they can't make enough.
They can't make enough. Demand off the charts.
I make certain judgments when I see people driving Escalades, but we'll leave
All
that
positive
off
judgments,
air.
you mean? That's what you're implying. Yes, of course. Of course. Pras, thank you. Appreciate it. Barclays saying near-term headwinds for EV giant Tesla, but strikes a more optimistic tone in its long-term perspective, lifting its price target on the stock. This was an interesting note, Julie Hyman. So Barclays out with a note. Key themes to watch in the earnings print. Focus back to fundamentals, at least for a brief moment, they say. Yeah. Investors are going to have to actually consider what they say still challenged fundamentals in this print. We see risk of stock reversion to the extent that the results disappoint. And says, indeed, Q2 could affirm continued pressure on margins. Yet also what's interesting, they say there could be only short-lived pressure given the excitement about the company's moves in robo-taxi, FSD, Optimus, the robot, et cetera.
Yeah, this was, sometimes you get this sort of disconnect between the tone of a note and the action of a note. And this is one of those examples because he is raising his price target on the stock to $225 from $180. But to your point, in the short term, he doesn't sound super positive. He basically says that the short-term fundamentals are not great for Tesla right now because of that pressure on the automotive gross margins. We're going to get a reminder of those short-term pressures when the company reports, which, by the way, is July 23rd. And that can bring the stock down a little bit because it's been flying on stuff that doesn't have to do with short-term fundamentals, whether it's self-driving, robo-taxis, et cetera, the stuff that is not happening the company's not making money from right now, or at least not a lot of money. So, it'll be interesting to see how this plays out.
Near-term headwinds, though, says also, listen, when he looks farther out, leads in the global EV transition, emergence of the software-defined vehicle.
Right.
Position it very well, he says, in the long term. But to your point, near term, some possible challenges ahead.
Yeah, the long term is where that price target increase, I guess, comes from. Well, TD Cowen is downgrading Charles Schwab from buy to hold. That's after the company reported earnings on Tuesday. The note saying there are too many moving parts and not enough earnings power. We have been we saw the stock fall yesterday. It's down another 6% today here. And this note really pinpoints that the company had a surprising introduction of potential balance sheet shrinkage. And we want to make clear here, we had talked about the company shrinking, but it's really the balance sheet that they are talking about shrinking here, that they are addressing that here, and that they are going to rely more on off-balance sheet arrangements in order to house customers' deposits. In that way, they're going to be shrinking that part of the business.
Yeah, and back to the TD Cowen note, it was interesting, because they did point out also, not all is lost, they say. They told their clients, they do point out some reasons for optimism, right? They still see outsized year-over-year EPS lift into 25, 26, but that was not quite enough. They do move to the sidelines.
Yes, exactly. All right, shares of Novo Nordisk and Eli Lilly are slipping today after promising early-stage trial data from Roche's latest obesity drug. Joining us with more, senior health reporter Anjali Kamlani. Hi, Anj.
Hey, Julie, that's right. Roche giving us a peek at the data of its second candidate, an oral obesity option that will compete against Eli Lilly and Novo Nordisk, also working on their own oral pills. And it also puts it in a competitive market. We know that Amgen and Pfizer are also working on their own versions as well. So this really puts Roche in a strong position. We did see a little bit of an update in a 6% weight loss compared for the patients in 4 weeks. And that is just a number in the phase 1 trial. I'll emphasize that we do not know how that translates into later stage trials. So while it is promising, we'll have to see how it actually pans out. If you recall, Pfizer recently had a bit of a setback with its candidate having to reduce from a twice daily to once daily, and that also is reaching mid-stage trials. So the competition is heating up, and Roche is definitely in the game. And this, it's important to point out, is part of its acquisition of Carmot. We know that it did target the weight loss opportunity there, so it's definitely panning out.
And Anj, we just got earnings from Johnson & Johnson. What can you tell us about that?
Yeah, Johnson & Johnson had an interesting quarter and was looking to kind of a tough second half with a few things playing in there. Now, we did see that they did continue to grow, but they did miss a little bit on the medtech side. That is a little bit of where they're facing pressure. Their medtech sales, while increasing, have been kind of flat over the years. And so that is an area where they're really looking to grow. That's part of the Shockwave acquisition, which has put pressure on the quarter. They had to instead cut the guidance for the year based on that, based on the financing of that deal. And then they're also looking ahead at the second half of the year, which includes things like the IRA, Medicare drug pricing, and what the actual price will end up being there. We're going to find that out in a few months, as well as biosimilar competition of Stelara in Europe. They're also bracing for competition here next year. And then inflation continues to be a headwind, according to CFO Joe Wolk. So looking at, a couple of unknowns there, the one positive is that they are able to bring back from their contact lens side. They had some manufacturing issues, as well as the settlements for the talc litigation, as well as mesothelioma. They're waiting on a July 26th vote from the defendants in the from the plaintiffs in the talc case. And that is going to then determine sort of what their burden is over there, whether or not the settlement agreement goes through and then takes off that overhang as well. So while still a strong play as usual, we did see that downgrade in guidance and just a little bit of headwinds ahead for J&J.
We will keep an eye on it. Thanks, Anj. Coming up, big gains come in small caps. We're taking a look at the best positioned names in the Russell 2000 in our investor playbook.
Oil rising in today's session after data showed U.S. crude inventories fell for a third straight week. Yahoo Finance senior markets reporter Inez Ferre here with the details. Inez.
Yeah, Josh, and if we just take a look at where WTI ended up today, it's up more than 2%. This was after more than a 1% decline yesterday. Brent crude up 1.5%. Part of this increase has to do with the EIA numbers, the Energy Information Administration, which said that energy firms drew down about 4.9 million barrels of crude from storage last week. That's quite a bit more than what had been forecast. You also have some geopolitical risks that are playing into these prices as well. A Liberian oil tanker, which was attacked in the Red Sea. And you also have a weaker dollar, which has been driving up the price in oil, because remember that oil is invoiced in US dollars. Analysts have also been noting that the Fed, if investors expect the Fed to be cutting rates in September, that would also spur the economy. So you have some buying going on because of that. And I just also want to note, besides the oil prices, futures, I also want to note what's been happening with energy stocks, because you do have investors that have been rotating into energy. XLE today up 1%. Over the last 5 days, you're seeing that energy is one of the top gainers as well. And I spoke to one analyst that has been saying that there's been a lot of talk about the odds of a Trump victory in November. That would likely be positive for energy stocks, because oil then wouldn't become obsolete as quickly as some had feared. So for the entire energy fossil fuel complex, you can expect to see these energy stock prices go higher, guys.
Ines, thanks a lot. The Russell 2000 set to snap its 5-day winning streak. The small cap index slipping today after climbing almost 10% over the past 5 trading sessions. In that time, it has outperformed the S&P 500 and the S&P equal weight since July 10th. But with so many names in the small cap index, we're looking at how to navigate the trade with the Yahoo Finance playbook. And we're joined by Sandy Villere & Company portfolio manager. Sandy, it's good to see you here. So first of all, let's just talk broadly about the small caps, the rotation we've seen in. Do you think it's justified, and do you think it's going to continue? And do you think people should be buying small caps as a group?
Yep. Yeah. Sorry. Yeah. So I'm very excited about small caps, and I think they've had a little bit of a, just incredible run. And I think it's basically just as a small cap investor, it's just been so lonely out there, just waiting for, tech to maybe pull back a little bit or what have you. And we're finally seeing it. It all started with the inflation print, right? Once inflation was a little bit cooler than expected and people expecting the Fed to cut in September, which looks like a foregone conclusion, then small cap finally caught a bid. And in my mind, the small caps are so much cheaper, trading about 14.5 times earnings. When you look at the S&P 500 at 25 times earnings, it just felt like it was time to have an opportunity to move into small caps. So we're very excited about the backdrop and think there's better days ahead for small cap even after these rallies.
Sandy, I'm curious, just broadly, when you look at small caps, what does earnings growth look like?
Yeah, so we're expecting robust earnings growth, right? And even when rates go down, right? Even if you're looking at 14.5 times earnings, remember when rates go down, and there's a lot of leverage that small caps use. So I think the earnings are actually going to be even better than what are currently modeled into those forecasts. So I think small caps have an incredible tailwind behind them and a great opportunity to get involved again, even after the rally we've seen today.
Just to push back against this a little bit, Sandy, there are some skeptics about small caps. One of them is Eric Johnston over at Cantor Fitzgerald, and he was looking at the longer-term profit margins of the Russell 2000. That's the chart we're looking at here. The red line is the 10-year average. He says we're kind of bumping along that 10-year average here at a time when valuations are relatively elevated. I know you were just talking about relative valuations as well. Meantime, Savita Subramanian over at Bank of America has said that if you look at about a third of the members of the Russell 2000, they don't make money, right? There's a lot of money losers in there. So how do you kind of think about that if you're going all in on them as a group?
Yeah, and there is a lot of exposure to biotech and companies that don't make money. So that's a hard metric to sort of look at. But again, in this backdrop, if you just look at, when the Fed lowers 12 months after the first cut, small caps have outperformed large by about 11 or 12%. And that's going back, since the 1950 or something like that. So it just looks like the setup is good. They've really been left for dead, not only over the last year, but over the last 3 and 5 years, with the Mag 7 just basically, in control of almost all the returns. So it's nice to see a shift, and I think that shift continues.
And Sandy, let's get into some picks here. One, I know you like First Hawaiian, ticker FHB. It's up about 8%, looks like, this year, Sandy. Why do you like that name?
Yeah, I mean, this is a very stable business. So, this bank was started in 1858, to give you an idea, largest bank in Hawaii. While we wait, we get a 4.5% dividend yield. The depositors themselves are extremely loyal to the island versus the mainland, and so their cost of funds are much cheaper than their peers. I just think it's a very inexpensive bank that nobody's really cared about, and I think it's got an opportunity to make 15 or 20% when you include that dividend yield without a lot of risk to it. So we like First Hawaiian.
This next one that you like is probably better known to consumers right now, talking about On Holdings, the shoe company, the upstart shoe company that's really roared higher over the past few years. The market cap here is $12 billion. And I have to admit, Sandy, I guess I thought of small caps as being smaller than this, but $12 billion, it does fit into that category. So where do you think the trajectory looks like for this one?
Yeah, it's got a lot of momentum. One of the most premium, shoe brands right now. Nike certainly struggled, and I think when I want exposure to the consumer, you probably want to get it through, Walmart, Amazon, or Costco. But otherwise, I want to be exposed to the high, kind of that higher end consumer that isn't going to blink, when they go to spend money on a premium brand like On Cloud. And, they're going to have a lot of exposure at the Paris Olympics, and I think that's going to help them out. It's not inexpensive. You're trading at 23 times enterprise value to EBITDA. Now, it was a small cap when it went public 2021, but it's had a lot of growth. The retail stores are going to be good. They've got, maybe 20 in China, 10 in the US and Europe. And I think that is going to be ultimately 10% of their revenue. So a lot of growth ahead. And I think they're still in the second inning probably of what this shoe company will be.
And Sandy, another one here, Option Care, ticker OPCH. Stock it's in the red this year and over the last 12 months, Sandy, but you clearly see better times ahead here.
Yeah, I mean, this is really the largest independent provider of just home, therapy treatments. So when somebody's going to get an IV, they're going to get it done at their home. They can also get it done in a clinic. But I think when you just follow the money, the insurance companies love this because it's cheaper for people to get, their an IV in their arm, let's say at home or in one of their clinics versus the hospital. And obviously the consumer loves or would rather be at home than going to battle a big hospital. So they had a small, I'd say a little bit of a shadow on top of them, I would argue, with one of their division called Change Healthcare that was part of United Healthcare that was actually had a cyber attack. So they had about 50% of their claims that they were struggling with. That's all lapping. That's all coming through. So I think when they start to report, things are going to be much more, clear for them. The stock is cheap, especially when you look at, multiples on either takeout or anything else. And so I like this one a lot. It's been left for dead, and I can see it, I see 28 to 30% upside over the next, 6 to 12 months, frankly.
Sandy, great having you on the show today. Thanks for your time and for those picks. Appreciate it.
Thank you. Appreciate it.
While wrapping up today's market domination, don't go anywhere. I've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street. And now it's Market Domination Overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session. So let's take a look at where the major averages ended the day here. We did have a mixed picture and a pretty divergent picture once again here today, with the Dow gaining about 244 points at 0.6%, but the S&P sharply lower 1.4%, and the Nasdaq having its biggest sell-off, I believe, since late 2022, down here by about 2.8%, and really showing once again the rollover in mega cap tech and in the chip makers on some of the stories that we've been talking about today and some of the concerns about trade with China. Jared's got a closer look right now at today's sector action and what else is going on. And of course, we've been talking a lot about small caps recently, which ended their winning streak.
Yes, they did. You can see down 0.9%. What were they up? 6, 7, 8 days? Don't recall. But yes, I'm glad you highlighted that divergence between the Dow and just about everything else today. And that's something we've been tracking for a bit. But usually small caps follow the Dow, not today. And today, in fact, we are seeing tech have a really lousy day. Tech is down 3.9%. We're going to take a look at the Nasdaq 100 in a second. First, I want to point out the consumer staples is in the green for 1 1/3%. Energy also up about 1%. But let's check out that Nasdaq 100 and see where the problems lie. And it is in the chip space. All right. NVIDIA down 6%. More concerns about export controls on the chip space. ASML down 12%. That company directly involved. And let's just go see the semiconductor heat map here, where it's looking pretty ugly. And you will note Intel is in the green. That stock was up about 6% earlier in the day, but it has given up almost all of those gains. So even Intel, not subject to those export controls, somewhat affected here by the sell-off. Global Foundries also up about 6%, it looks like, but also off of its highs. Now, elsewhere in tech, we can see software, another red day, and in profitable tech, we'll finish with that. Yeah. In the red too. Guys?
Thanks a lot. Appreciate it, Jared. We've got to get to some breaking earnings news here. It is United Airlines. The share is taking a quick leg lower. Second quarter earnings beating estimates, but passenger revenue coming in below estimates, and the company's forecast for the third quarter below estimates. So let me run through the numbers real quick. That's sort of the overall summary. Second quarter adjusted earnings per share, $4.14. $3.93 is what analysts had been anticipating. But second quarter passenger revenue per available seat mile down 2.9% year over year, and passenger revenue overall coming in at about $13.7 billion, which is in line to slightly lower than had been estimated here. The company's third quarter adjusted earnings per share forecast, $2.75 to $3.25. Analysts had been predicting on average $3.38. So there was a lot of concern over what United was going to say, Josh, after we heard from Delta, which is viewed by many as sort of best in class among the airlines. A lot of concerns about costs, a lot of concerns also about how well demand is matching capacity within the airline industry. And now we get a little more clarity on what's going on.
Yeah, the stock was up about 15% this year heading into the print. You can see it's given about 5% back now in the after hours. I think you hit on some of those themes, Julie, that I know top of mind. Domestic pricing environment. Analysts are quick to note. They know, broadly for the industry, it's been very promotional, but I do know the magnitude of the pricing pressure. It has surprised some. That'll be a key theme on the call. What analysts want more color and commentary on. I also know a lot of focus for United on international. What do they say now and ahead? Asia, Europe, and also United's capacity plans, given just aircraft delivery delays. Will also be top of mind.
It looks like they're commenting a little bit on what's going on with fares here. They say, because there has been discounting, there have been fare cuts. They said that some of those fare cuts could moderate after the middle of August. So that's something that we'll keep an eye on here. The company says also it plans to remove 3 points from its domestic capacity in the fourth quarter. And this is something, as I say, that the airlines are trying to get right now. What's the correct capacity to match the demand out there? And obviously, there was overcapacity here for a little while, and that's why we're seeing some of these fare cuts and some of these airlines not perform quite as well. Just one more headline that I'm noticing here. It looks like adjusted CapEx for the full year will be below $6.5 billion. It had seen $6.5 billion. So unclear how much below that it's going to be spending. but it seems to be signaling they're going to be spending a little bit less this year than
We've got a
previously.
very smart analyst coming up, break all
Yes.
those numbers down for us.
We do.
Meanwhile, stocks closing mixed today with the tech-heavy Nasdaq leading the day's losses. The rotation out and away from mega-cap names in the past few days, stoked by trader optimism on interest rate cuts. Earlier today, Fed Governor Christopher Waller saying in a speech that the Fed is getting closer to cutting rates, though not there just yet. Joining us now is Kara Murphy, Chief Investment Officer at Kestra Investment Management. Kara, good to see you.
Yeah, thanks for having me.
So maybe, Kara, we'll start on just the moves we saw in the markets today, because they continue to be really interesting. And obviously, like the Nasdaq slipping today, there was a lot of focus on the chip names with headlines and maybe some worries creeping up about possible trade restrictions on chip sales to China. What did you make of it all?
So I think today's action is sort of needs to be taken in context of the last couple of days as well, because we've definitely been having this big shift in leadership in the market, and I think it's one that many of us have been anticipating for a long time. You know, if you look at over the last 6 months, 80% of the constituents of the S&P 500 have underperformed the index. So it's a sign that, you know, again, this theme of market being driven by very few names. Now, all of a sudden, we get a couple good inflation prints, a couple good labor prints. Looks like Fed can start to cut interest rates, and all of a sudden, the macro environment starts to change. And I think this is a hint of what is going to turn out to be a broader trend. Now, it's not going to go in a straight line. It never does. But what we're seeing is that anything outside of those market leaders, smaller cap names, more value-oriented, less growth names, can now suddenly get a little bit of life in this idea where we have lower interest rates. Now, the technology sector is interesting because that's an area that's done incredibly well. And there's a real fundamental change with this threat of higher tariffs or penalties. So that's a real fundamental change. But it's coming out in an environment where expectations have gotten very, very lofty for a lot of those names. So I think just shows how vulnerable sometimes names can be after they've been in favor for a long time.
Is tech an area where you are lightening up, or where you're selling, or what are you doing with regard to tech stocks?
Yeah, so interestingly, even in tech, that sector has been very driven by a handful of names. So I still think, you can't paint the whole sector with a broad brush. So there are still really good, interesting opportunities there. There's also really good fundamental earnings support. I just think it's going to be less than what we've seen, and you need to start rotating outside of those mega cap names.
Kara, I want to get your take on small caps too. Obviously, there's been a lot of talk about them. It was interesting because earlier in the show, we were talking to Ed Yardeni, strategist economist, and we asked Dr. Ed, listen, your take on that. He was not a big fan, it didn't sound like. Said he wouldn't be chasing the small caps here. He looks under the hood. He sees, actually just a lot of biotech, a lot of smaller banks. To him, it looked like a lot of short covering. But what's your take? What are you telling clients?
Yeah, I think small cap it is a little trepidatious, right? Because we still have a high number of firms in that area that lose money. So you have some real quality issues. But if you can lean into smaller cap names, now that also includes mid cap, which I think is a really interesting area.
Why do you think mid cap's interesting?
Because you have companies that are a little bit more established, a little bit more mature, a little bit more diversified, better balance sheets in general, but largely ignored by a lot of the market, right? Everybody's been rushing into the S&P. So if you step down just a little bit in market cap, you get a really rich area for stock picking. Now, if you layer in a little bit of quality on those names, then you can avoid those like big money losers. So I think you can avoid some of those traps. And then if you have a lower interest rate environment, those are the names that are going to benefit the most.
I want to talk a little bit more about sectors as well. We talked about tech. Infrastructure is one of the other areas that you're looking at right now. And it's an interesting one because some of it, infrastructure in very broad strokes, some of it is going to be policy dependent, right? And so I wonder kind of what does infrastructure mean to you and where you're looking?
Yeah, it is such an interesting area because I do think that this is a trend that is a multi-year trend, right? We've underinvested in a lot of our infrastructure in the US for decades, so there's a lot of making up to do. It's also one of the very few policies that both sides of the aisle can agree on. Now, they might implement a little bit differently, but I think everybody agrees we need to upgrade a lot of our infrastructure. So yes, it's policy dependent, but we already have a lot of spending that's in the pipeline that hasn't actually been spent yet, and that will take time to kind of filter through. And my guess is that whoever ends up in the White House is going to have to focus on this and have additional programs to support it as well.
Interesting. All right. Thanks so much. Good to see you,
Thank
Kara.
you.
Thanks
Appreciate
for coming in. United Airlines earnings just crossed the wire, and we're going to have more from the airline's second quarter results next, and perspective instant analysis there on Market Domination Overtime. That's coming up.
United Airlines reporting mixed second quarter results. Earnings per share coming in above analyst estimates, but operating revenue did come in light. And joining us now is Peter McNally, Third Bridge Global Sector Lead for Industrials, Materials, and Energy. Peter, it's good to have you on the show. So at least initially here, Peter, investors disappointed with this report. You can see the stock's down the after hours about 3.5%. But what did you make of it, Peter? Give us your reaction.
Well, I'm going to say in the short term, there really weren't too many surprises. I mean, the company reiterated its Q2 about 6 weeks ago, and they did okay, but we've gotten a heads up that, or most of the market has gotten this heads up now, that the airline industry is softening. There's just too much capacity, right now, and we're at a peak demand season, and it's weighing on the revenues outlook. So we got that from Delta last week, Spirit earlier, this week. So I think it's more of the same, and United is not immune from these issues facing the industry. I think it gets more interesting for United longer term. I mean, you guys noted that CapEx is looking lower for this year, and some of that will be driven by Boeing's deliveries, but a lot of United's future plans are dependent on them getting newer planes. They really want to go after this premium segment, and that is going to depend on those deliveries. So how that gets pushed out will be the key question that we have for the earnings call tomorrow.
And Peter, something that we've been trying to wrap our heads around is this sort of juxtaposition between TSA numbers, for example, which are continuing to show records, and then the airlines sort of struggling with this capacity issue. Is it just that they thought the numbers were going to be even better than they have been?
Well, I think, post-COVID, people are, people really want to travel. And a lot of capacity was added by all the airlines, particularly in the domestic market, which opened up first, and everyone headed to Florida, Texas, California. And, they weren't alone. And there were a lot of planes around at that point that were came back in service. So we're on the tail end of that now. And while the Boeing issue has been, a major problem, it's more really, like in the case of United, to displace old aircraft. And these new aircraft that they would be getting have two effects: is you get more revenue per seat, in that you get a lot more flexibility in the cabin, and they're more efficient. So you'd have an improved top line and bottom line, and those things are kind of being squeezed, with these delays here.
Peter, when you look at the domestic pricing environment, I know there were some analysts covering the industry who said, listen, they were aware, obviously, it was promotional, very promotional, but some of them were telling clients they were kind of surprised by the magnitude of the pricing pressures. Were you surprised, Peter?
Maybe the magnitude is, I would call like a little bit surprising. I mean, there were no secrets how many planes that were out there and the discounting that had been going on. I guess, the alarming thing is that this is occurring during the peak travel season. So the impact here, in the third quarter, which we're just, a couple weeks into, is really being felt. And frankly, most bookings are done here, and then you're going into a very soft period in the fall. So there are some concerns as we head into, into the holiday season, but it seems like United's taking a proactive approach here. But this is going to be the big question for the rest of the industry as we go through, is what does Q4 look like? Because that's going to determine the year.
Yeah, and the company sort of touting what it calls its revenue diversity here in its statement. It talks about premium revenue rising 8.5%. Year over year in the second quarter, basic economy revenue up 38%, and the company said what it calls market share among domestic road warriors was higher in the second quarter. Do some of those factors make it better positioned than some of its competitors? And I know Delta is also very favorably viewed by a lot of your peers. Are they also going to come out of this stronger?
Well, the way we see it at Third Bridge, there are two big issues facing the industry here. Let's call it in the medium to long term. Is one, the availability of planes. Like, can you get them? And I think everybody understands what's going on with Boeing. But the second thing is this premiumization that all the major carriers are chasing. Right? We've had these ultra low cost airlines really make inroads, but it's the front of the plane where like the major carriers recognize that there's an opportunity and they're chasing after it. Now, how they attract those clients is very interesting. American has stumbled a bit, and our experts tell us it's really all of their own doing. It's created some opportunities for Delta and United rather. But it is the space to watch here, is that people recognize these are your most profitable travelers and everyone wants to go after them.
The Olympics, Peter, coming up in Paris, how does that impact United, if at all?
Well, as Delta said, it's actually been a negative in that a lot of tourists who would have gone to Paris are just avoiding it this summer for, I guess probably the 3 weeks around the games. So it has been a big destination, but people certainly are traveling to other parts of Europe. And that is why like the Uniteds and the Deltas and the Americans have done a little bit better than, let's say, the domestic only focus carriers are the ones that are heavily focused on domestic, JetBlue, Spirit, Southwest, et cetera, that don't have that cushion.
Peter, good to see you. Thanks a lot.
Anytime.
Well, the election outcome in November not likely to do Alphabet any favors among regulators amid its reported bid to buy Wiz. Here with more on the likely scrutiny ahead for what could be Alphabet's biggest ever acquisition. Let's get to Yahoo Finance's Alexis Keenan. This has been a big topic of discussion amidst that reported interest in Wiz, whether it would get through regulators.
Yeah, so there's no guarantee whether it's Biden or Trump in November, then come January. No guarantee that the antitrust watchdogs are going to give this deal a green light. You have, under the Trump administration, a lot of mergers being challenged, also anti-competitive conduct alleged against, you have to look at the Google Fitbit deal, that was under Trump. Also, Facebook, challenging Facebook's acquisitions or trying to undo WhatsApp, Instagram, then bringing a challenge against its attempt to acquire Within. So if there is a $23 billion deal or any deal at all, it is the type that antitrust experts are telling me is going to attract attention from regulators. One reason, it's Google, it's Alphabet. Regulators are interested in all the deals they're going to do, and particularly when it's their largest deal ever, big deals. The attorneys say that under either administration, the FTC, the DOJ, we wouldn't know where this would go quite yet if it's announced and if it's filed for. But they say at least expect a preliminary view, right? That 30-day examination where regulators can go in and just say, tell us more about this deal and let's look into this market. Maybe they say a second look. That's a more in-depth look, and maybe even a full review, maybe a challenge. Long road to get there. Bottom line is, the attorneys that I've talked with, all of them have said this is going into 2025. You can expect that this is going to take some time. Now, we did have an analyst from Jefferies, I know, on Yahoo Finance say, predict that there's 0% chance of regulatory pushback here. For one, it's a vertical merger. Google not really operating in this cloud cybersecurity space that Wiz is in, but that's not what I'm hearing. A former FTC official also told me that there's no chance at all of just a clean pass on if this is a deal. At a minimum, he said that regulators would want to know if the deal would foreclose on direct competition, downstream market competition, and also the regulators have been trying. They tried it in the Facebook Within effort to challenge that. There's this attempt to look at deals that are potential competition. So when you have a really big dominant firm trying to acquire a piece of business that could affect potential competition, it's a really underdeveloped area of law, and it's one that regulators want to see developed so that they have something to hang their hats on and say, this is how it should go. So they could go down that road. We just don't know. It's too early to tell.
All right, Alexis, thank you. Appreciate the update. Time now for what to watch Thursday, July 18th. Starting off on the earnings front, Taiwan Semiconductor, Netflix, D.R. Horton, and Domino's Pizza reporting tomorrow. Netflix announcing results for the second quarter after the close. Analysts expecting big numbers from strong engagement and subscription growth.
Moving over to the Federal Reserve, we'll get another round of commentary from Fed Presidents Lori Logan and Mary Daly, as well as Fed Governor Michelle Bowman. This coming after comments today from Fed Governor Christopher Waller and Fed President John Williams, suggesting the central bank is closer to cutting interest rates given inflation's improved trajectory.
And taking a look at the job market, we're going to be getting weekly jobless claims data in the morning. Economists forecasting that number to increase to 229,000.
And finally, tomorrow, the last day of the Republican National Convention. The top headlines out of that so far: former President Donald Trump officially getting the Republican nomination, and of course picking his running mate, Ohio Senator J.D. Vance.
And that's going to do it for today's Market Domination Overtime, but don't go anywhere. On the other side of the break, it's asking for a trend. I've got you covered for the next half hour, the latest and greatest market moving stories, so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton. For the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. Here's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we're going to be diving into. A tough day for tech. The Nasdaq led losses today, sliding nearly 3%. Nvidia, Meta, Alphabet, and Microsoft all closing lower in the latest sign of a pullback from mega cap tech. A Bloomberg report that the Biden administration was weighing tougher trade restrictions on semiconductors, also hitting big chip names. Plus, checking in on autos, new car prices have decreased just 3% from last summer's record highs. That's according to data from Copilot, as higher rates continue to keep buyers cautious, and a recent cyber attack threatens to rock the industry further. We're going to be monitoring the silver linings in today's auto markets. And plugging into the state of gaming, Hollywood deals, major acquisitions, and the disruptive promise of AI, all could have wide-ranging impacts for video game companies and their audiences. We're going to hear from the former president of Nintendo later on in the hour. New data this week showed retail sales rose in June by the most in 3 months. The only loser, the auto industry, largely a result of a cyber attack on CDK Global, a software company. Joining us now is Pat Ryan, Copilot CEO, founder. Pat, it is good to see you. And maybe I'll start there, Pat. I'm interested to get your insight. CDK, just walk us through what happened there and what have been the ramifications, Pat, you're seeing kind of still ripple through the industry.
Well, I mean, it really threw the industry back to the Stone Age in a lot of ways, because with the systems locked down, they couldn't do business the way they are. These are typically their systems of record. And as their systems of record, they're kind of the hub for everything that they do. So like when you saw hospitals that couldn't access hospital records, same kind of problem. It really just, it was the perfect place to hit to cause maximum chaos in the largest, retail vertical in the economy. And it took, put everybody back to pencil and paper. You couldn't get data. The entire industry relies on real-time data to be able to know how to price cars, to be able to know how to market cars. You couldn't update your website. You couldn't get information to send loans to the banks. I mean, it just gummed up everything. And now it happened at a time that the market's been slowing, but dealers feel a lot of headwinds. I think it really added insult to injury for people who are feeling that slowing from rising interest rates already.
Well, let's talk more about that, Pat. Let's say you're a viewer, you're in the market now for a car, and you got your eyes on a new car. In terms of pricing, Pat, we teased that a bit in the intro, but just walk us through what we're seeing there.
Well, I mean, we saw something unprecedented during COVID. We saw used car prices go up in ways that we frankly had never seen. I mean, who thought cars were appreciating assets like stocks? That was sort of unparalleled. And that peaked maybe a little over, a year ago. It started to really accelerate down. The new car market, we went from 3.5 million cars on dealers' lots before COVID started to a low of under 1 million, about 900,000 cars on dealer lots. And so that's all healed. And as it's healed, the normal behavior you expect, used cars depreciating, has started to happen. New car prices, you're not seeing cars by and large sell at sticker or above in the same way they did before. But that being said, we had a structural increase in prices, and that structural increase in car prices has left consumers with sticker shock, because the average new car went up dramatically in price. The average used car went up dramatically in price. We're still up over 30% from pre-COVID. So there's sticker shock for people who haven't bought a car since before COVID. And then when you add in that most cars are bought with financing, about 80% of cars. And so when your car's bought with financing, interest rates go up and prices go up. That has a compounding effect that has really made them unaffordable. But it hopefully has achieved what the Fed wanted, which is to start slowing the economy. And you're seeing it in car sales, and you're seeing it in affordability, really having reached crisis levels and now starting to put downward pressure on prices finally.
And Pat, let's say you're out there in the market for a car, you're looking for a deal. You say there are some options, including, I thought this was interesting, used EVs.
Yeah, the big manufacturers saw Tesla and got a lot of Tesla envy and said, "Oh, we can do that too," but they really misjudged the adoption curve on consumers. Consumers, between the concerns about range, the need to have charging in a home, versus if you live in a parking lot, the consumers have really not been ready to adopt. We got into sort of the high single digits of adoption, and the mass market just wasn't ready. And, people like GM and Ford and a lot of the big European brands have made bets that we were ready to adopt. Meanwhile, the Toyota and Hondas of the world realized, having dealt with the technology adoption curve before when they introduced hybrids 20 years ago, they realized sometimes these things take time to be able to move from the early adopter market, which Tesla dominated, into the the mainstream market. And so the EVs are really been piling up on dealer lots, the over 120 days supply. A lot of great deals to be found there because they basically just outkicked their coverage in production. And so it's a great time to be buying EV. But ironically enough, it's a great time to buy an EV because consumers want hybrids. It's a way to be green. It's a way to be cost efficient. But
hybrids, hybrids still running hot, Pat?
Well, they're still not as hot as they were, but they're running hot. Toyotas and Hondas are just popular generally. So there's really a tale of two markets. You know, the Stellantis dealers have dust on their cars, and the Honda and Toyota dealers are still very hot, hotter than they were before COVID. And part of that is hybrids. Hybrids are not as hot as they were, but they remain hot relative to the rest of the market.
All right, Pat, we're going to leave it there. Thank you, sir. Appreciate your time today.
Thank you.
The rotation out of high-flying tech stocks continues. Concerns over risk to tech names eclipsing high hopes for Fed rate cuts. Yahoo Finance's very own Josh Schaefer joins us here with more on the trading day takeaways. Joshua.
Yeah, Josh, we got to start with tech. That was the big story of the day. So I'm going to flip over to the Wi-Fi Interactive here and take a closer look at what we saw. So as you mentioned earlier in the show, we obviously had that report out about the Biden administration potentially putting stricter restrictions on what would impact a lot of chip makers' business with China. You can see here, it really took a lot of tech too, but specifically when you take a look at the semis, I mean, it was really a bloodbath in there. It was not good for the semis today. And I think the interesting thing is just how that sort of impacts the overall index. Now, we should mention this happened right around this time last year. There was reports too about NVIDIA potentially having trouble in China. And if I pull up the NVIDIA chart and we go back a year, I think we'll be able to see it. If we go back a year, you'll see that you got to pull back last August a little bit there, and then it ended up rallying back out of it. And really what that was earnings. And we're coming up on big tech earnings, right? So we had a big tech sell-off today. We know there's been that rotation out of tech, but you sort of have the fundamental driver of this rally still coming at some point in the next couple of weeks with earnings. NVIDIA doesn't report until the end of August. So it'll be interesting to see sort of how these stocks trade going into earnings. We know they're up a lot, but there will be kind of more fundamental backing coming at some point.
Yeah, it was interesting because SMH, I mean, the ETF that tracks the chips, you know, it slipped today, but it also, I mean, when you pull back that chart, Josh, the move, even to after today, I mean, it's up like 45% this year.
Right,
I mean,
we're talking about stocks that are mostly up over 100% this year, over 100% in the last year, having a 5% pullback. There's still some serious gains there, right? And then the other side of this, though, was it wasn't really a bad day everywhere. And I thought this was interesting. I was taking a look at just the sector action today. And when you look at what we had throughout the day, I mean, you have 5 sectors in the green, 6 sectors in the green, 8 sectors outperforming the S&P 500. But this is your big one, right? Tech falls almost 4%. And you have communication services falling 1.5%. These are the bigger sectors in the S&P 500. So we talk a lot about this rotation, right? The rotation out of tech into a lot of these names. But I want to pull up a chart for you. So we just talked about something like energy, something like utilities, right? When we look at the weighting of the S&P 500, so this is how much it contributes to the index, look at how big tech is. So if tech falls almost 4%, it's a tough day for the S&P 500 to set a new record. And I think that's kind of the trend to focus on moving forward here when we keep talking about this rotation. That means it's probably going to be a slower chug higher for markets. When the big companies are doing really well, you have what we had to start the year. Now it's going to be a little bit of push and pull, I think, which will be more interesting to follow.
With what worked today, did you see kind of any threads connecting what worked?
Yeah, I mean, when you take a look at the sectors, largely it was still the rates trade, right? You have a lot of interest rate sensitive sectors in the green here. You have sectors that have underperformed, XLRE, consumer staples, healthcare, all haven't been great sectors performance-wise over the last 2 years. So to see them sort of keep outperforming, I think shows perhaps people still looking for laggards, right? And a final point on this, Josh, that I thought was interesting that Callie Cox brought up to me over at Reholtz Wealth Management. She just said for index investors, it's important to remember on days like this how much you've gained already from big tech over the last 2 years. The index is up about 18% this year. That's a pretty good year.
Yeah.
So if we just kind of do this teetering and tottering for a couple months, you're still sitting on 18% gains, which, you know, isn't all bad.
Right. All right, final Trump trade.
Signs of the Trump trade, right? We've been talking a lot about it, and I thought this was an interesting one. So Eric Wallerstein, the chief market strategist over at Yardeni Research, highlighted this on X today, and he said this is sort of one part of the Trump trade he's been watching. So we're looking at Lazard and Evercore. They're big players in M&A. You look at their stocks, they're up about 10% over the last 5 days. Of course, the last 5 days is when we were talking about people feeling more confident that Trump might win this election and sort of markets pricing that in. Well, this is one way to think about that. If Trump were to come into office, the general theory goes M&A will be a little bit easier. There'll be perhaps less restrictions with a Republican in office. And so you see a rally there. I think it will be interesting leading into November as we sort of get perhaps more confident or less confident with who's going to be in office, what starts to outperform, and little pockets like this I thought was kind of an interesting thing to highlight.
Yeah, it's interesting because, elections coming up, so everybody tries to sort of game that out, which I get, and it's a fun, smart thing to do. It's just so hard though, Jack, because even with the deal making, Republicans, let's say, you have to give the edge to Trump and Vance right now. And so you would initially think, okay, Republican, good for deal making. But on the other hand, Senator Vance, when he talks about Lena Khan, he has nice things to say. So it's tough to game out.
And people often aren't right? When they try and guess what sector is going to outperform. Here's one for you, Josh.
Yeah.
What sector outperformed is the same sector that led the S&P 500 through the last 3 presidencies?
Give it to me.
Technology.
Easy.
That's a secular trend, right? It didn't matter if it was Obama, if it was Biden, or if it was Trump. It was just technology leading the S&P 500 higher. You didn't have to think too hard about it.
That's it. That's your portfolio. There you go. Thank you, Joshua. Coming up, the WNBA has reportedly agreed to $2.2 billion media rights deal, but the questions still linger for the NBA rights and if Warner Brothers Discovery will be back in the mix. More on that when Asking for a Trend returns. The NBA has reportedly agreed to terms for its next media rights deal, and it looks like Warner Brothers Discovery's TNT network could lose out. For more, let's welcome in Yahoo Finance's Alexandra Canal. Allie.
Hi, Josh. Yeah, and if this is true, it would be such a gut punch for Warner Brothers Discovery. I mean, they have aired these NBA games since 1989. They currently shell out $1.2 billion. That's going to expire, though, at the end of next year, which is why these new rights are being negotiated. But Comcast, NBC Universal, that's going to be a new player in there taking over some of these rights. Now, the NBA has reportedly agreed to these terms. Not only is it Comcast, NBC Universal, Disney's ESPN, which is a current media partner, they're going to actually increase the amount they pay to the NBA and hold on to some of those games and playoff games. Then we also have Amazon Prime Video coming in there as a new sort of tech presence for the NBA. But Warner Brothers Discovery, they still have the option to match these offers, and that's something that we're currently waiting on. We did speak with Rich Greenfield from Lightshed Partners about what could potentially happen. I want to play a little bit of what he had to say earlier today.
But I don't believe that Warner Brothers really wants to spend $1.8+ billion on a rights package for a much smaller package with less playoff games than they have now. I think the reality is, look, there's a pretty vicious debate among investors. Is losing the NBA catastrophic for WBD because they're at risk of getting dropped by distributors, whether it's a YouTube TV or a Comcast? Will this sort of be the end of carriage for this company, or at least a significant haircut to carriage? Or is saving $1 billion+ a year, they currently spend about $1.3 billion on the NBA,
So that's the big debate here for Warner Brothers Discovery. Is it actually better for them financially if they just take a step back? Because they have been doing other types of rights deals with college football. We have the UFC rights coming up. Maybe that's something that they go after more aggressively as well. So that's something that Rich Greenfield said is going to be a big determining factor moving forward. Is what are these other rights that they could potentially gather that could stem some of the bleeding if they were to lose NBA? Of course, there are other analysts out there. Pete Supino from Wolfe Research said that Warner Bros. Discovery could lose $600 million yearly in profit if they were to lose the NBA. So it's one of those things where it's going to be a wait and see to see how this is going to affect the company's bottom line.
So that's NBA, WNBA, also making some headlines.
Right, so this is part of this NBA deal, and they're going to be getting paid. The league will reportedly receive about $2.2 billion over the next 11 years in media rights with those same companies we were talking about, Disney, NBC, and Amazon. And we do know that the WNBA, it's certainly gained some positive recognition recently. You have big stars like Caitlin Clark really coming out of the woodwork there and receiving some fandom and during the games and the season as well. I did have the chance to speak with and the NBA Deputy Commissioner Mark Tatum about this. He said that the interest in the WNBA is actually also increasing interest within the NBA as well. So it's this ecosystem that they think is incredibly important. So I'm sure the WNBA is going to continue to gain traction as well.
Yeah. All right, thank you, Allie. Appreciate it.
Of course.
Moving on, it's been a difficult landscape for video games over the last couple of years with big layoffs across the sector, but there have been some positives too, increasing popularity with TV adaptations like The Last of Us and Fallout, bringing relevance back to game franchises. For more on the industry, we're bringing in Reggie Fils-Aimé, former Nintendo of America president and COO and author of Disrupting the Game from the Bronx the top of Nintendo. Reggie, it is good to see you. I thought, Reggie, be interested, kind of big picture. You know, the gaming industry, Reggie, we know, during the pandemic, everybody's at home, it booms. But as we spin forward here today, Reggie, sitting here July 2024, how would you kind of grade, assess the health of the industry, Reggie? How strong, how healthy, how resilient does it look to you?
Sure. Well, first, thanks for being with you. You know, I think it's important to put this into context. The overall entertainment industry is large. It's a significant part of the global economy, and gaming is the biggest part of that. It's a $200 billion business today. It's bigger than streaming, bigger than the movie box office. Across the globe, 3 billion people play video games. So it's still large, it's still vibrant. And as you said, it did spectacularly well during the pandemic, and then contracted slightly following it. And I think it's important to understand why. You had significant investment leading into the launch of new machines by Microsoft and by Sony. You had essentially free money. So game developers were creating a plethora of content, and candidly, some content that probably shouldn't have been created. That hit the marketplace, and it candidly just didn't do very well in 2003. So the market contracted. Where we are today, I would say that the games industry overall is poised for an upswing. Just this past month, late last month, there were a number of game announcements across the industry that consumers reacted really well to. These are new games coming later this year. It's games that are coming in 2005. There's new platforms coming, namely from Nintendo, as well as rumors of an adaptation to the PS5 coming. So there are a lot of positive things that signal that we've essentially gone through the trough for the video game industry, and now we're poised for an upswing.
I'm interested, Reggie, when you look ahead, listen, there's a lot of companies betting big on VR, AR, mixed reality headsets as ways that they think people are going to really love gaming in the future. Do you believe in those platforms, Reggie? You think they'll prove really popular with gamers?
So this is where I take very much a contrarian point of view. AR and VR, especially VR, has been an area of the business that people have talked about that are going to be, that it would be huge, that it would bring in a completely new form of entertainment. And candidly, it just hasn't happened. If you look at the overall sales of headsets, it actually peaked a couple of years ago. And that's despite of the latest MetaQuest coming late last year, as well as the launch of Apple's Vision Pro this year. And so you have to ask the tough question, why? Why is this part of the business stagnant? And I would say that first, there really aren't great experiences that motivate you to go out there and buy a headset and to keep using it. And that's critically important. And then given the lack of great applications, the headsets are perceived as incredibly expensive. The Vision Pro is an eye-watering $3,500. The MetaQuest 3 is about $500, which is about the same price as a PS5 or an Xbox Series X that has a ton of great games for any type of player. So, especially the VR space is in a very difficult place right now. I'm not super optimistic unless there comes a number of really great pieces of content that motivate the consumer to go in and buy.
What about, Reggie, there's some excitement about cloud gaming. I know nascent now as an industry, but you think that's a technology that investors and gamers are going to be excited about looking out?
I think that cloud can be a very interesting technology, but I want to be clear. It's just a technology. It's just going to be another way that consumers can get access to games. In the end, this is an industry that is driven by content. And when you look at great content that's coming, there are a number of great games that were announced that are coming later this year. There's a new Zelda game, for example, where you actually get to play as the princess. There are great new additions in the Call of Duty franchise. Next year in 2025, there's a new Grand Theft Auto game that's coming that's generating all types of buzz and anticipation by the gamers. In the end, if these games are made available through a cloud type based system, that's what's going to drive cloud as a platform and as an industry. It always comes down to the games.
Let me ask you this quickly, Reggie. I got to ask you, you're a veteran of this industry. Is there a game you're playing now, Reggie, that you're a fan of?
So here's what's interesting. I think in terms of what's happening right now, I think there's three different types of games out there that are doing really well. There's a bunch of sequels that are out in the marketplace right now. There's a new Helldivers that's been in the marketplace for a couple months. It's doing really well. There's a new Hellblade that's doing well. There's new content for a game launched in 2022 that's called Elden Ring that's doing really well. There's great indie content out there. There's a game called Animal Well that's doing well in the marketplace. And then you've got gamers like me that play a game to its fullest level of completion. The game that's candidly taking up the most of my time is a game that was launched a year ago, and that's the Legend of Zelda game for the Nintendo Switch. So, I think what's important about this industry is there truly is something for everyone, and that's what's going to help this industry get out of its doldrums from late last year.
Reggie, great having you on the show today. Thanks so much for making time for us. Appreciate it.
Thanks, Josh.
Stay tuned. More Asking for a Trend right on the other side. The Russell 2000 snapping a 5-day winning streak today. The recent run-up fueled by optimism around imminent interest rate cuts, but there's still skepticism surrounding small caps and their profit margins. Joining us now with our chart of the day, Julie Hyman. Julie.
And indeed, Josh, we've been talking to people who like small caps, right? Sandy Villery today, who we spoke to. We spoke to Carrie Murphy of Kestrel, who said she likes mid caps a little more than small. But we've definitely seen this big rally in the small caps. Well, one of the skeptics in the longer term sustainability of this rally is Eric Johnston. He's Cantor Fitzgerald Chief Equity and Macro Strategist. And he laid out his case in a recent note to clients here where he talked about we're just not going to see the earnings growth. And he says valuations are pretty elevated here, particularly for the Russell 2000. He also talked about profit margins for the Russell 2000. And you see here a 10-year chart of those profit margins. As he pointed out, they've kind of been trending downward as of late. And not only that, he says, the 10-year average, he said, is unremarkable. He said profit margins have been falling and now unremarkably in the middle of a 10-year range. And so you see this is the 10-year average. And indeed, we're sort of bumping along those levels right now. So he doesn't think the recent rally is justified. One of the other skeptics that we've heard from is Savita Subramanian of Bank of America. Our Josh Schaefer sharing the comments with me that she made about small caps, where she pointed out around a third of the Russell 2000 has unprofitable companies. So if you're looking at them as a whole, it's a tough bet to make rather than if you're doing some stock picking. Then, of course, Ed Yardeni, who we talked to earlier today, Josh, talked about that maybe some of the rally that we are seeing is short covering. And for that reason, he too seems to be a bit more skeptical on the small caps.
For sure. Okay, Julie, thank you. Now let's take a look at what's trending here after hours. Shares of Beyond Meat tumbling after hours. The plant-based meat company is reportedly engaging with a group of bondholders about a balance sheet restructuring. This, according to the Wall Street Journal. Beyond Meat has run into issues as of late. In its first quarter results, the company did post a wider than expected quarterly loss, an 18% drop in revenue. The company's volumes also fell more than 16% as consumers pulled back on spending. That is a wrap on today's Asking for a Trend. Have a great night.